A very good evening and a warm welcome to Personal Finance. I'm Kukuletu Kele. Since March this year, South Africans have been entitled to tax-free savings accounts. Now, we've covered the topic on the show before, but tonight we want to break it down and look at tax-free savings accounts for different age groups. Joining me now to share their insights and expertise is Bradley Drury, Research and Product Development at Alexander Forbes Financial Services Group, and Dharmesh Bhana, General Manager at Nedbank Retail. Thank you so much for joining us today, gentlemen. Maybe let's get a quick recap on tax-free savings accounts, Dharmesh, and maybe if you can provide perspective there for someone who isn't familiar with them just yet, you know, the limitations and the objective that government is trying to achieve with the launch of these products.
Okay, so I think it's a good initiative, firstly from government, really in the South African context to sort of promote savings within the masses of South Africa, because we're not too great at saving anyway. The requirements came into play on the 1st of March 2015, and you saw all the financial services providers scurrying to sort of provide these things. But very simply, you have a contribution limit of 30,000 Rand a year, and it's a contribution. So, if you go and take money out, you can't go and put it back in if you've reached that cap of 30,000. So that's the limitation, and it's open to all individuals, within South Africa, with a lifetime contribution limit of 500,000 Rand. Over your lifetime. So that's some 16 odd years that you would be able to contribute 30,000 Rand a year to tax-free savings, with the key thing being obviously returns within those investments being tax-free.
Exactly.
So that's very simply what it's all about.
Maybe you can give us more perspective here as well, Bradley, because obviously it applies differently for people in different ages and different situations in their life, especially given the type of saving strategy that they need to implement. Maybe if you can give us the actuarial background as to, the risks involved with different age groups. I take it someone who's in their 60s would need something maybe slightly more aggressive than their younger counterparts.
Well, yeah, someone in their 60s less aggressive, exactly. But it's to encourage long-term savings. That's the ultimate message. So South Africans are notoriously bad savers, and it's probably been deteriorating over time. And this was an initiative to try and boost that level of savings, but it is targeted towards that long-term savings level. And that's why part of the design is not allowing that replacement of contributions. So if you do withdraw, you can't put your contribution back into it to try to discourage withdrawing. But at the same time, you are allowed access at any time. And that's because one of the things that do stop people from savings is thinking if you put your money away, you're not going to get access to it again. And so although you will always have access in the regulations, you do want to save towards the long term. So it is more suited for younger individuals. So if we look at, say, it's open to minors, I'd actually start there. So kids less than 20, and that's a good opportunity for parents with young children. Open a tax-free savings account in their name, put contributions in there when you can, let it build up. To get the most benefit from it, you want to try build up to get your contribution limit as fast as you can. That's when you get the biggest growth. So the long-term benefit comes through twofold. So obviously compound return, so earning interest on your interest, but now it's a bit of an enhancement because you're earning tax-free interest on your previous tax-free returns. And the second benefit of why it's more suited towards long-term investment is currently we already do have certain tax exemptions. So we have an interest exemption in place and a capital gains exemption in place. So if you're looking for some sort of short-term investment, less than 5 years, it doesn't make sense to use up your tax-free investment because you have limited contributions. Rather put your short-term savings somewhere else. There you can get access. You're not wasting your tax-free contributions, and you'll probably still fall below the existing tax exemptions. So this is really targeted at long-term savings. Open it for your kids. Let the grandparents contribute into the account when they have an opportunity to do so, and then young individuals in their 20s, early 30s. Again, maybe complement your retirement savings, but we're looking at very long-term horizons here to get the most benefit from tax-free savings.
I want us to focus on that, especially the kind of exposure that people need to get, which is something that the ordinary man on the street might not be familiar with, because you've got your banking products, you've got your equities-based products, you've got ETFs as well, which can be very confusing. But let's zone in on 20s and 30s. If we start out there, what kind of investment strategy or philosophy should they have in place? Bradley, maybe if you give us perspective, and Dharmesh, you can come in here too.
20s and 30s, I'd look at people trying to maybe complement their retirement savings. So you're at a very young age now. If you're looking for a 40-year time horizon until you retire, you want to maximize your exposure to growth assets. So things like equities, property, for example. And while the tax-free savings is nice to complement your retirement savings, is in your normal retirement fund, you do have those Regulation 28 restrictions. So you're limited to 75% maximum equity exposure. When you're young, in your 20s, early 30s, you want to maximize your exposure to growth assets. You could use your tax-free savings account to make 100% equity investment. Now all of a sudden your overall exposure to growth assets in your overall pot of retirement savings is now increased above that Reg 28 restriction. So it's a good way to complement your retirement savings. Also, again, that access difference between retirement. So if you're in your 20s, 30s, retirement seems a long time away and you may not want to commit those savings to retirement funding, then in the back of your mind, you do know that you do have that access should you need it. So those are two reasons why it's a nice way to complement your current retirement savings if you're in your 20s or 30s.
Dharmesh, I take it you agree, and maybe from Nedbank's standpoint as well, there are these kind of products available.
Yeah, they are. So, I mean, the unit trust, sort of the wealth cluster within Nedbank offers the whole bunch of unit trusts. Which I'm not really going to talk to too much today, but it is definitely an option for people that have a 30,000 Rand available. You know, if you look at the sort of country in general, the masses don't really have 30,000 Rand at hand, and that's where we sort of come in with an entry level of around 50 Rand, where you can start investing, and we're going to pay you sort of 5% at that level, which basically in the past was unheard of across the service providers. So there's one way of saving. But I'd also say that if we're looking at education, if we're looking at what we want to save for our kids, what we want to do in sort of retirement, my advice is really to go and have a chat to a financial planner, go into the branches, have that conversation face to face. And it costs you nothing, a little bit of your time, okay? But there's a wealth of knowledge within that space that'll give you what you need based on your requirements and where you are in your life stage. People in their 20s or 30s might be looking at a whole bunch of asset stuff, so they might be heavily indebted, which we do know in South Africa, and might be sort of risk averse as well, in which case, equities might not be where they want to invest, in which case they'd look at bank deposits as an example, and it might not necessarily be tax-free savings either. So there are a whole bunch of products with a whole bunch of different interest rates and returns, dependent on your risk appetite, really.
What about the more mature audience as well? Because one wonders, if you're 60 years old, your investment outlook and savings outlook isn't very long term, 20 to 30 years. How do they need to adjust their view when it comes to identifying the right product?
Generally, it's conservative. People have worked for, let's call it 30, 40 years in some instances. They've got pension payouts that have come out. And generally, they want to preserve that capital. So they'd probably go into something that's not as risky, probably not high equity exposures. And we see a lot of that coming into our space in terms of bank deposits. And they would look for, guaranteed return, guaranteed capital, and they'd look longer term. So they might even fix their money in a fixed deposit as opposed to a notice deposit, where accessibility to the cash is not as forthcoming. So you wouldn't get it in 24 hours or immediately, but it's fixed for a 6-month, a 12-month, 18-month, and at times a 5-year period as well, with the interest being something that seniors, our senior citizens would sort of live off.
I want us to talk about that outlook as well that you mentioned, the access to the capital. Is that also something that these investors or savers need to take into account? That many people want the easy access 24 hours, but the tax-free savings accounts are not necessarily placed for that.
And I think so we always speak about the tax benefits of tax-free savings accounts, and that's the encouragement to get South Africans to save. But there's two other benefits in terms of the design that government are hoping encourages people to start savings, and I think are often overlooked, and that is the simplicity of these products. So in the actual regulations, the principles that are trying to be followed are simplicity, transparency, and suitability. And it's not just an existing savings product that we now have tax-free. A lot of providers have come out with simpler versions to start saving. You spoke about minimum entry level, so people who wouldn't have had access to savings previously can now start to look at saving. I think everyone has good intentions to start savings, but if you're a first-time saver or maybe not as financially sophisticated, when you go out into the market and have to look, how do I start saving now? It can be quite intimidating to know where to start looking. And I think tax-free savings products, besides the tax benefits, have used the opportunity to now have a simple, easy to understand savings product that will hopefully take that extra step to encourage people to start savings. The second part is, again, also access. So the intimidation factor, and then am I saving? Will I get that money back if I need to? So we all may have an intention to save for the long term. So that's I want to save for my child's university education. That's my intention. But we know times can be difficult. A geyser bursts or your car breaks down, and maybe you do need funds access to those funds. And knowing at the back of your mind that if that situation does arise, that you can get access very easily, and there's quite a lot of liquidity in these tax-free savings accounts, will also go further to encourage the level of savings.
Well, time now for us to recap on the key takeaways from this evening's discussion. Dharmesh, let's start off with you. For someone in their different age groups, the key things that they need to take into consideration before investing in a tax-free saving account.
So I'd say firstly, number one, start. So start, open the account and actually start putting money into it. Make sure you do the 30,000 Rand a year if you've got it, okay? Third one, big one, which we haven't really touched on so far, is don't over-contribute, because if you over-contribute, you get taxed at about 40% of the capital. So if you go 100 Rand in excess of 30,000,
sure,
40 Rand is going to be taken as tax. So if that's 1,000, it's it's 400. If it's 10,000, it's 4,000. So it's 40% of whatever that capital contribution. So that's a key thing. I think people need to make sure that they don't over-contribute per annum. And you can't do the full 500,000 once off, which I think a lot of people that have that type of money would look to do. And I think that's it for me. Make use of it, open it, and make sure you don't go and access it.
I want to come to you quickly, Bradley, before we take a look at some of those who might have that spare change available, where else they can put that money in, because I think that's also delves into some of the other products that might be available from both financial institutions. But Bradley, from your side? Yeah,
so just to touch on the over-contribution limit, if you have multiple tax-free savings accounts, make sure you don't go over that 30,000 Rand contribution limit. If you're with one provider, the provider will ensure that you don't go. So they won't actually accept any contributions above 30,000 Rand. So it's a bit of a safety net for the person, knowing that if their debit order went off at 40,000 Rand for the year by mistake, that 10,000 Rand will be refunded, provided it's with the same provider. It's when you have to keep track when you're with different tax-free savings accounts.
Exactly.
Yeah, so in terms of other investment products where you could look at for an individual, again, look at your specific situation, speak to a financial planner. They can see where it suits you. But if you have high levels of debt, rather look at paying off your debt first. That has a high interest rate, get rid of that. Set up an emergency fund for yourself. Again, the tax-free savings is more longer term. If an emergency fund that you may need to access quickly in the short term, have that set aside first. And then look to possibly enhancing your contribution towards a retirement fund. Again, which is more beneficial between tax-free savings and your retirement fund will depend on various factors specific to you. But my sort of overall takeaways would be long-term investment. Make sure you start contributing early. You want to get to your limit as fast as you can and leave it invested for as long as possible. That's where you get the greatest benefit.
The eighth wonder of the world, compound interest, not so. Gentlemen, unfortunately, we have to leave it there for this evening, but thank you so much for your insights. Well, that's where we have to leave it for Personal Finance this evening. A big thank you once more to Bradley Drury from Research and Product Development at Alexander Forbes Financial Services and Dharmesh Bhana, General Manager at Nedbank Retail. Remember that we want to hear from you, so send us your questions, insights and comments to @CNBC Africa using the hashtag Finance410 or to myself at Gukumfupi on Twitter. Until next time, it's goodbye for now.